Welcome back to 15 Minutes of Finance, where in the next 15 minutes, I bet we can get you excited about investing. Let's do it.
Let's do it, baby.
All right. Today's episode is about the infinite banking glitch and other lies of the insurance world. And we're going to be looking, one, at a case study to illustrate just how much of a misnomer this infinite money concept is. And we're going to look at some other areas of the insurance world and how they're sort of peddled as investments, but are almost always categorically worse than comparable investments when treated the same way. Okay. Right? Is that fair to say?
Yeah, it's a great topic.
All right. So let's get into real quick. I'll give the listeners a breakdown of what do people consider this infinite money concept, and then we can kind of get into the weeds and we can look at this case study.
I love it. Okay.
So the idea of infinite money banking is this insurance term. It was created by a specific person. He's written a book on it. His name escapes me right now. And the concept is this. You have an insurance policy, which for a universal life policy has multiple components. You have insurance that you're paying for. As most people think of life insurance, you pay for a death benefit so that if you die, there's a lump sum that gets given to your beneficiary. And then there's the other component, which is the cash value component. The cash value component is comprised of what you pay into the insurance policy above and beyond what you're paying for the cost of the insurance and potential fees and expenses of the administration of the insurance as well. So some people massively overfund their insurance. Let's say you put a $800 a month premium payment in. Only, let's say, $50 of that is going to go to the cost of the insurance and the fee. So now you have $650 that just added to the cash value. Yeah. And the idea is that you're getting interest on that cash value, the same that you would with another investment. And so as that cash value builds, there's two things that happen, they claim. One, the cost of the actual insurance cost ends up being able to be paid for by the dividends and the interest of the cash value and the interest earned. And then you can take loans against your insurance policy. And so that's where they say that there's this infinite money banking where you build up cash value in your own policy, and then you can take loans against your own policy with the excess cash value remaining, continuing to pay not only the interest of the loan, but the insurance cost. So the money you took out is free and it's infinite because the money keeps building, and you can have your own loan, but you don't have to pay back the loan because the interest on the loan is being paid by the policy itself.
Man, that sounds great.
That sounds awesome. Right?
Sounds so good.
With a name too, like infinite money banking. Who doesn't want infinite money, right? Yeah. So break down surface level, and then we'll get into the weeds.
Sure.
Why do you, as one of the partners here, as an RIA, why does this not ring true for you? And why do you think that this is not how it works and not good for 99% of the people that it's sold to?
Yeah, one of the really most consistent things that you'll learn in the fee-only space or fee-based space is that all these products that pay a commission, they are heavily sold and very rarely bought. Okay, so this is a product that is sold and not bought, and that means that it gets sold to everybody even if it's not a great fit for people, right? That is why it's probably one of the most common things we're hearing right now on TikTok, right? Is they're just trying to get it in front of as many people as they can, and then, infinite banking sounds great, right?
Right.
10 people buy, that planner or insurance agent or salesman, whatever you want to call them, makes an immense amount of money off these policies. And they're incentivized by these insurance companies, by their broker dealers, to sell commissionable products because it makes everybody, except for the person who buys it, extremely rich.
Right.
And there's infinite banking for them and not for you.
And there's two components here, right? So the agent is going to get a significant commission, right? Yeah. Potentially $10,000, depending on how large this insurance policy is.
In perpetuity, too.
Right.
It goes along as long as the policy's alive.
Right. And then there's either the insurance company or an advisor on the account that's making money on the managed money that you're getting interest off of, usually interest that's significantly lower than market returns.
Yeah, and we're getting a little ahead of ourselves as far as the details that we're talking about, but this isn't a mutual fund. This isn't an ETF. These are specific funds within an insurance policy, and they're in the annuity world, they're just called sub-accounts. Okay. So I would assume it's the same thing.
Yeah.
They're just sub-accounts. Always a base fee of 1% is usually the standard.
Yeah.
So you have an immense amount of things eating at your your money.
Right. So we don't want to talk in generalities here. We want to prove it to the listeners. Yeah. So we brought with us an actual case study. This is a client we are currently working with right now that we have also worked on many other capacities. So this is a tax client, it's a wealth management client, and now we're kind of consulting on the best way.
Financial planning client now
Financial
too,
planning client. And now we're looking at an existing policy to see, should he stay in this policy or should we move elsewhere? So we're going to show it on the screen. You guys can look at this, and then we're going to go line by line and explain what all this means. And for those of you who are audio only listeners, our OGs, if you will, continuing to listen on Spotify and stuff like that, we'll try to break out as best we can the numbers here. So this is an insurance policy, so it's a indexed universal life policy. That's what that builder IUL means over here on the product side. So it's an indexed universal life policy. So that means the return you're getting on the cash value is in some way indexed to an investment, either the market or some other indexed, rate of return. There's a couple components here. There's a lot, as you can see here. So first is the death benefit. So you're buying $575,000 in insurance. So if the holder of this policy dies, the named beneficiary on this policy would get $575,000. So that's the same as if it was a term policy. That's the death benefit. Now we get into the complexities of this. You can see that there's a $400 a month premium on this policy. And then it breaks down the cash value and how it grows. So we see we started with $27,692. It raised by $4,800 plus the interest on the existing cash value. But then there's all of these costs. And this is where we get into why we would not recommend this policy to almost anyone, but in particular, the person that it was sold to, who you can see as of the date of the policy, this person was 27, working, healthy man. That's the recipient or purchaser of this policy. So we see there's a premium load fee. There's the cost of the insurance itself. There's other expense charges, which let's just stop right here and say this number is egregious. $910 on expenses on a less than $28,000 policy. There's almost no investment product in existence that fee makes sense for. That's ridiculous, right? Absolutely ridiculous. We would get $910,000 if we managed over $100,000 of someone's money to manage the money. And then we go down to the return, 6.5%. What did the S&P do in 2024, James?
25%?
Yeah, 25, 26%. We're getting 6.5%. So we're paying roughly 4 times what we would pay an advisor to get a return that's a fourth of the return we would have if we were just sitting in VUG, in a indexed ETF, right? But then it gets even worse. What if we actually want this money? We lose $6,647 as a surrender charge to take money that is our money that we've been putting into this policy. But then if we ever want to use it, we pay them more than a fifth of the value of the policy. To surrender. There's about 15 horrible things about this that we can get into, but what is the surface level sort of thought you have? You look at a policy like this, what stands out?
Well, other than the fact that it's not a good product, the biggest thing that stands out to me, and we know about the client, but you guys obviously don't, is this was sold to a teacher.
Right.
So this is someone who the school said, hey, this is an expert. They're going to just, put on a webinar, or it's not a webinar, a presentation, or a luncheon, something like that.
Seminar, maybe?
Yeah, a seminar.
Yeah.
And, teachers like, oh, how can I better my finances, right? Well, they go to this, and this guy is pitching this not as life insurance. This is a product that is pitched as an investment vehicle, which is why I have such a big problem with this. Okay, so if you want to get insurance, we're okay with that. We think insurance in the right situation makes sense. This as an investment vehicle has got to be on like the bottom rung of options.
Yeah.
The first thing that stands out is it doesn't make sense. You are a teacher, so your salary is probably $60,000. It's California, so maybe a little more.
Sure.
He's not married, doesn't have any kids, doesn't have any dependents. Why does he need $600,000 of life insurance? Yeah. Why is that something that he is needed? Well, he doesn't. So the person selling this said, oh, let's talk about the cash value side.
Right.
Okay, so that is where this really gets people, is it's sold as an investment. And so the cash value side of any universal life product is one of the biggest scams in the industry. It's presented to you as this tax deferred growth vehicle that you can always access. It's like, be your own bank. That's the infinite banking, right? If that side continues to grow and grow and grow and grow, then eventually it will be self-funded and all of the expenses and et cetera will come out of that cash value, but it'll still grow. And now you have a bank that just pays for your insurance and is an investment and grows, when in reality, it doesn't work that way.
Right.
And even if I guess in reality, it does work that way at a 5% clip of how it's sold to people. It's sold as this extremely efficient vehicle, but in reality, these people are getting 4 or 5% on their money. And then guess what it costs to take the loan out, Brandon? 4 or 5%.
Yeah, I just looked up before this episode, and it said ranges are usually between 5 to 8%.
So even more than I thought. Yeah. No, that breaks my heart.
So and so we can prove it. So we say this is a bad investment policy. It doesn't get you what other things would. So we broke it down for you, and we overestimated everything. So we said, what if the same 27-year-old goes to someone who actually has their best interests at heart and wants to maximize their investment return as well as the amount of insurance they have? They're not married, they don't have kids, but maybe it's really important that a younger sibling has security if they pass, right? There's other reasons you can have death benefits. So they really want a death benefit. So we assumed that this 27-year-old got $1 million of term insurance. So for 30 years, if they die by the time they're 57, $1 million, so almost double the death benefit, goes to the beneficiary. And then we said they just sat on the rest of the money under their mattress. They didn't do anything else. Well, a quote for someone remember, more insurance is about $72 a month, so $850 a year to get an almost double death benefit off of a term policy. And I overestimated almost every aspect of this. Most quotes are a little lower, but I wanted to be conservative. So we say $850 a year. So with that cost, after 10 years with this $400 a month premium payment, assuming they wanted to put the same amount into a combination of insurance and investments, they would have $39,360 sitting under their mattress. No return, no interest, no nothing. Well, what's their actual cash value before the start of this 10th year? $27.6 thousand. That tells you $12,000 has gone to fees, to pay agents, to pay the insurance company, to pay administrative costs. And it's really more than that, because they're getting, quote, interest on their money. It's not really interest because the fees outweigh the interest, but they're getting interest on the cash value, which means the fees were even higher than that because they had additional cash value added in interest on their cash value. So the actual true value of the amount of fees they've paid is probably over $15,000 over the course of 10 years. So we added a parallel track. Well, what if the same client was just no advisor, no risky investment strategy, no complexity? They put their money in the S&P 500 and VUG and SPY, whatever you want to invest in, and they got the average rate of return of 10%. They'd have, again, almost twice as much in insurance on a term policy, and the remainder invested over 10 years, putting in, I think it comes out to $39.50 left over in investments, because the insurance is now only $850. They'd have $62,953 invested, which is a difference of $53,510. That's after taxes. So assuming they sold it, because the big thing they sell is, well, you can access your cash value. You're an infinite bank with no interest rate, with no loan. After long-term capital gains tax rates, they would have $53,000 that they could access at any time.
Yeah.
So first of all, here's a challenge to any indexed universal life policy seller that claims this is an actually good investment because of this infinite banking policy. Come on the show. I'm going to look in the camera when I say this. You are invited to the show. We will have you on and we'll debate about these numbers. And if you can justify this position, we'll change our stance. There is an open invitation to any insurance salesman to come on and explain to us how this makes sense.
And you know what's funny is Brandon is much better at having those kind of conversations, because I just get like emotionally angry. I'm just like, you can't look at this. And I know it's a lot going on in this policy, guys, and like you might be like, where are we drawing these numbers from? I mean, there's this policy, this piece of paper tells a story.
Yeah.
It tells a story about what's happening. And these insurance guys, which I'm not dogging them, they got to make money. They got to, do what they got to put food on the table, but they get stuck in the insurance world where that's all they know. It's our job, Brandon and I's job, to be aware of other options, right? Because we have to make the very best recommendation for clients. And like, we're not experts on a lot of things like REITs or private equity firms or funds, those types of things, but we're aware of them. And we know, we have a good enough concept of whether or not that might be a good fit for somebody. These insurance people selling these insurance policies, this is all they know. So like Brandon is talking about coming on the podcast, very unlikely anybody actually does, because they don't know what they don't know. If someone came in here, say like the best agent in the country or something like that, that person has conviction based upon these policies, right? They absolutely believe in this. But they're not going to be able to argue against well, what if they did this? Well, what if they did this? These IULs, these policies, especially universal, is typically sold to the extremely wealthy, where they don't even care about the fees. None of this stuff makes any sense, like, to them. They're just like, oh, like, I get a death benefit, and then if I ever need to access something tax-free, they can take a loan against their policy, right?
Right.
But in this scenario, this is a teacher.
Yeah.
I mean,
you got to feel a little bad about.
This is a teacher. This is, yeah. So again, that's why Brandon is much better at the debate side of stuff, is I get far too emotional. I mean, this.
And so to clarify what we're talking about here, $400 per month for 10 years. This teacher has put $48,000 into this, quote, investment vehicle. And what they have for it is $27,000, of which, to get it, they would have to pay in fees another $6,600.
Yeah. Which to, and this might be a good time to jump into it, but the client comes to us, says, hey, here's this policy. What do you think of it? The math unequivocally says, eat that surrender.
Yeah.
Eat it.
Yeah.
Pay that surrender fee. Get that cash value, whatever. So it's $27,000.
So after the surrender, it'd be $25,900.
25.
Yep.
Okay. So 26. Just take that and invest it. You'll make the difference up within a year and a half.
And you can test it for yourself. Google FV calculator. Type in the first one. It's the same one that always comes up. It's the most used tool, future value calculator, and put in $26,000 and assume, one, that you're going to keep putting in this $4,800 every year, and look at how much goes to fees at an abysmal interest rate, versus put in $26,000 at market rate for 10 years, 9 to 10%. If you want to be conservative, do 8%. You'll see that it pans out. It pans out. You're going to get more money paying $6,600 to abandon the policy. That's how bad it is.
So when we had started the episode and said these things are sold and not really bought, it means a teacher's not going out and going to research a IUL and say, that sounds like a great investment. I'm going to do that. That wouldn't happen because it's such a bad fit. But this agent took time to go make a presentation, to come to the school, to set time aside to be able to present this in front of people, and probably did a good job.
Yeah.
Right? So that's what I mean by sold and not bought. Obviously, someone bought the policy, but the proactive initial first step was a selling process.
Right.
And I mean, you're going to just initially trust that person. You are. I can't normally function normally when I think about just the egregiousness of this.
Well, it's the old, what you're talking about is super important, because that is exactly what happened to me without me really truly.
Oh yeah, the LERP.
Without truly understanding the extent of it, it's like the old saying, if your only tool is a hammer, you're going to treat every problem like a nail, right?
Yeah.
So that's right. They call themselves advisors. So for someone who is trusting, who doesn't have the knowledge to understand the levels to advisory, these are the options available to them. But you're not given an option of, I'm going to manage a portfolio for you comprised of treasuries and ETFs, because the insurance agent can't manage money for you. They're not certified to do that. They're not licensed as a financial advisor. So they say, here's your 3 options. And this might have looked the best out of the options, but what's not being told to you is there's 50 other options that the person you're talking to legally can't even talk about because they aren't an actual fiduciary advisor.
Yeah.
And so that's, I think, really why people buy these policies and why there's such a disconnect is you don't know what's not presented to you. So under the available options, it looks the best, but you don't see all the other options. So let's talk about the other options. For someone who's willing to accept market risk, for the average person who's 27 and wants to grow, obviously ETFs, mutual funds, a managed portfolio, they're all going to outperform this. So what do you tell the people that are older or more risk adverse? What are your options if you like the insurance policy of loss protection in down years? If you like the idea of a cash value that's not completely tied to market fluctuation, what are the other options available to those people and why are they better?
So we kind of talked about this. It's out. This as an investment vehicle is at the bottom rung. Right. This is at the very bottom of the options I would recommend for somebody. The options are almost endless. Let me just think about this in this guy's situation. So he's 27. He could probably do a Roth. He could probably do a traditional IRA. He probably has a 401k. Those are obviously just vehicles.
And for a teacher, it's probably a
403b.
403b.
Just the index would exceptionally outperform this return, this investment product. Just put it in the S&P 500. Okay, that's VOO. It's VWUAX. I think that's the mutual fund. Your 401k, your 403b, whatever this individual would have had, there's a fund in there that just tracks the S&P 500. It's pretty much required of all retirement plans to have a vehicle like that.
Yeah, and they'll all be different, but they're tracking. If you're with Vanguard, you're going to see a Vanguard fund. Yeah. That's probably VUG. I think VOO or VUG tracks purely the
VOO. VUG is the growth company.
Right. So you have VOO. Your company might have the BlackRock ones, iShares. There's an iShare that tracks the S&P. You might be with American funds. There's an American fund that tracks the S&P 500. So yeah, whatever your lineup is in whatever portfolio you're in that you could put more money into, there's something that just tracks the whole market.
And let's say you want insurance, right? This guy's like, I kind of want insurance.
Sure.
We just went over a term policy for you, okay? And if you're like, I don't want to go through the process of doing it, go speak to a financial advisor, okay? Go speak to one. You might think, oh, it's, that's for rich people. If you go in there and say you want an insurance product, you are rich to them. Because they're going to make some money off of that, not directly from you, especially if it's a term policy. The insurance company pays them that. So you go in there and you say, I want $1 million of term insurance. They'll do pretty much everything else for you. Right. They'll set up the Roth. They'll help you with your IRA. They'll advise on your 403b, your 457. They'll help you with a financial plan. They'll do everything. Okay. If you want to get insurance, it's a very lucrative situation for them. Yeah. And then you'll get help on everything else. Especially if they're an RIA, fiduciary advisor. But if you want insurance, there is nothing better than term. Nothing. Okay, I don't care what anybody says. You're paying $2 a day to get $1 million in insurance versus $400 a month.
Right.
I mean, I don't know how you could see that and not want to invest in that. Right. Go that route.
Right. So let's talk about other options as we kind of wrap up, or at least come full circle with this episode. This concept of infinite banking. Yeah. You create a cash fund that you can pull from when you need. So there's other ways to do this almost identically in function that are better than this. Yeah. And one of those are securities-backed loans. So people sell this as like, you want to know what the ultra wealthy do? You want to know what Jeff Bezos does? Jeff Bezos does not max out an IUL. He does not use index universal life policies and pump millions of dollars. But what millionaires and billionaires do actually do is they have a portfolio. So this client was 27. By the time this client's 50, if he invests $39.50 a month, which is the difference in cash by doing a term policy, he'll have millions of dollars between this and his 403b, and he keeps investing that diligently every year among other investment vehicles. Maybe he owns a house that by the end is $1 million he has paid off after 30 years. they'll have millions of dollars. Well, if you have that in a portfolio, you can take a securities-backed loan from the brokerage that you have your money in, Fidelity, Schwab, whoever it is. I looked up those rates also before the episode. Usually those, depending on the amount of money you have, are 2.5 to 6%. So if you have $2.5–3 million and you take a securities-backed loan using your assets in the investment account as leverage, you can do the same exact thing where you can take a loan based on the value you've built up, backed up by, in this case, it's not cash value, it's the value of your securities and treasuries and everything in your account. But functionally, it works the same way. You can take more money, you can have more money, you can pay less fees, you still don't pay taxes on that loan, and the interest rate that you're paying every year, as long as that loan is outstanding, is sometimes half as much as the interest rate on IUL. So if you're someone who likes this concept and likes to think like, what are the really advanced tools that a lot of people don't do? How do the rich have all this cash available but not pay taxes? That is an actual strategy. So much so that you can find articles online of people saying that this is something policies need to get rid of. It's not fair that these multi-billionaires have billions of dollars in stock assets and can take out loans. That's cash-free income. They can spend it, but then as long as Tesla keeps going up, Elon Musk doesn't ever have to pay that back because the growth in the value of his stocks is paying the interest on the loan. So that is an actual tool. If you're someone who's comfortable with debt and you like strategies like this, there are other ways to get yourself access to capital using your investable assets as collateral. That's way better than this egregious policy that you're paying $240 in premium load, $589 in cost of insurance, $910 in other expense. And that's all of those fees are off of only a $28,000 policy. These are going to be tens of thousands of dollars when you're pumping millions of dollars into this policy.
One thing you'll notice too is these are tools, right? You could do this, but you got to have money already. This policy was sold as probably a get rich quick, be your own bank. That's all infinite banking. All that sounds like wealth.
Right.
But you want to do it the right way, you have to already have money. This is the only person that gets rich in this situation is the agent and the insurance company. Okay. All of these policies they view you as their bank. Right. When you get sold this, they're seeing a commission. They're seeing an ongoing commission. You are not important to them. You have to be important to you. You have to say, I need to understand just enough to where I can go, I'm in good hands.
Right.
That doesn't take very long, guys. That doesn't take very long at all. I would say an hour a year. It would take me, if I didn't know anything, and I wanted to look up IUL versus whole life versus term insurance, I would immediately be able to see, there's a significant cost difference. There's a significant cost difference.
Right.
Okay, well, what about this cash value? Is there a benefit? This is investing it for me. What does that look like if I do that myself? And you just go through this cycle of what if I took control of my own decisions?
Yeah.
Okay. So if you have an IUL, please, you'll notice something on this statement here. Okay. And this is probably the most important thing that I didn't talk about with Brandon and I didn't talk about with the client, but you'll notice the most important thing, upper right, there's an agent and a contact and it's empty. Okay, it's empty. So if you had questions, the guy who sold him this policy isn't around anymore. He doesn't work there. He couldn't even ask that guy questions. Right? You'd have to call North American. North American. And there's hundreds of insurance companies, so I've never even heard of North American.
And I think now is a good time to interject here. What did the client say when he tried to call this company? Yeah. How was that handled?
So after we made the recommendation, hey, you should get out of this. Let's just get you some term insurance. The client's 34 now, by the way.
37.
37.
10 years, yeah.
And his term insurance would still be exponentially multiple times over cheaper.
Right.
Anyway, so when we made that recommendation, he called the insurance company and they were like, ooh, hey, for any kind of changes like that, it takes 2 weeks. We'll get back to you. But if he wanted to buy more insurance,
immediate connect.
It was an immediate connect. And he knows that because online they have waiting times. So if you want to cancel your policy, 2 weeks. If you want to add insurance, a 2-minute wait, right? Or a live connect immediately. Those are big, big concerns, right? These are set it and forget it for them. Once they sell you the contract, they're on to the next one. So a couple of things. Do your own research, at least an hour a year. That's not very long at all. And then if you know someone who has one of these, or you're the beneficiary of one of these, please speak to somebody. It took me 90 seconds to look at this policy and see that's a problem, that's a problem, that's a problem. Here's how we can do better, right? And if you guys have that access to somebody who can help you like that, over 30 years, we're going to save this guy hundreds of thousands of dollars and then probably make him hundreds of thousands of dollars. So you might be talking about $1 million difference between keeping this policy and getting rid of it.
Yeah. No, I think that's a really good point. And I want to add one important thing, which is to really solidify to the listener's mind, for us, this would be the greatest thing to sell. This is,
we'd make a lot of money.
We don't have to do it. We don't have to do anything because the insurance company is the one managing the, it's in a fund. We don't have to worry about it.
Yeah.
We get just trailing commissions. We don't have to worry about managing the money or have the liability of the money. We're going to get paid way more in commissions selling you this than managing $400 a month that you put into a Roth IRA that you manage. So if you talk to somebody, you could always fall back on this. No one's going to not want to sell you this. If you are like 100% sold that this is right for you, trust me, there's 1 billion agents out there that are going to be able to do that. So you should probably get someone's opinion who's willing to do something else for you because this option is always available. People want to sell you this. People in the industry, they're better off selling you this.
The companies are pushing this. North American probably has quota for these policies. And there's a really great Dave Ramsey little 8-minute clip where this guy who swears by his IUL policy, swears by it. They get into an argument for like 8 minutes. And the guy has zero answer to any of the very simple points about...
Off camera, I've dropped my water 3 different times in a row, and as I try to clean it up, I'm dropping my water again. That's why James is having a hard time.
We're having some moments over here, everybody.
Okay.
It's a beautiful argument between someone who is on our side of the table with this, term insurance, anything else, probably not a good fit, and then someone who is absolutely gung-ho, believes this is the best investment in the world.
Right.
And then one thing I did want to talk about real quick. So you'll notice on this sheet, again, let's go to the right side just so you guys can see what I'm talking about. And if you go to cash value, maybe I want to go to the middle here. Yeah, cash value. So we'll just do beginning account value and ending account value. That is $32,000 for ending, right? And if you go above it, you'll see death benefit. Unless you pay extra premiums and expenses, you don't get that ending account value that you've been putting money into every single month. Okay, you don't, or your beneficiary, excuse me. That ending account value gets kept by the insurance company, and so you have to subtract that 32,643 spot 34 from 575,
which is your own money that you've been putting in.
Money. Okay, that is probably the biggest issue with these policies. Now it's called I think it's a accelerating death benefit or level up death benefit. I can't remember entirely what it's called, but you can see the death benefit option here to the right of the death benefit. It says level. That means you just get that, but it might be like level plus, and then you'll get the ending account value too. That premium, I bet it's an extra $150 a month.
Yeah.
Which is just so much money at the end of the day.
Right. Where you could have $1 million policy and still have 3 times the money invested.
Yeah. So please, again, I've said this before, but if you have someone who has these policies, please reach out to somebody. It could even be us. I don't care. It'll take me 3 minutes to look at this, like I did with our current client. Just ask for help.
And look, let me add this too, because someone who buys this, if you're like embarrassed that you're in a policy like this, or you're like, I feel so stupid, don't feel stupid. Okay, I'm a CPA for almost a decade now. My California insurance license is pending. I'm 3 months away from having my CFP. I bought a policy worse than this. So
It was worse.
And
it was worse.
I had degrees in accounting and finance at the point where I bought that policy. I was early on in my career. I didn't know what I didn't know. Same thing. I thought, they're an advisor. I wasn't given a list of options. I was given a list of insurance policies that person could sell.
Yeah.
And it seemed the best of those policies. And it was obviously presented as much more attractive than it actually was.
From a friend.
From a friend. That's usually how it is. Look, these people are giving your 100. Your 100, what is it, top 100? Hot 100?
They Project 100.
Project 100, where you write 100 people in your life that you think would be receptive to that conversation. So it's part of the business. It's part of the business model to start with people that trust you. That's the business model. So it's probably someone you trusted. Don't be ashamed. I'm here as someone who now has a financial literacy podcast with James to educate people, and I fell for this early on in my career. So don't be embarrassed. It's not your fault. It's designed to sell things like you to make them money, not you money. But two, there's also a little bit of good news in this that we haven't talked about, which is, and this is California. A lot of states are like this, but I can't say for sure unless I know what state you're in. Most states have laws of transferability. So there is one silver lining, which is that any money you've put into insurance, you can transfer to another insurance policy without losing. So that's one thing we're going to explore with this policy and other policies is there are things like one-time paid up term policies where he can take this full cash value, transfer to a lump sum paid up 20-year term policy.
Pure insurance.
And there's no penalty on that transfer. Then the remaining cash value, he would have to look at what's the cost, what's the surrender cost to move it to other places. So one, don't be embarrassed to talk to somebody. They're not going to judge you. They're not going to look down on you. They're going to try to get you somewhere better. Don't look at it as a sunk cost. Well, I've already put 10 years into this. I've already built up $27,000 in cash value. I don't want to surrender this. Don't fall for the sunk cost fallacy. The only thing you can do is the best path forward now.
Yeah.
Don't be embarrassed. Don't look at this as a sunk cost. There's always a better move that you can make in the future. And you didn't waste everything. You can still transfer to a better insurance policy to meet your insurance needs. And then hopefully an advisor will help you look at with the remaining money, what the best path forward for you is.
These things are complicated. Okay. Otherwise, Brandon wouldn't have been able to be sold such a terrible policy. Okay. And it's complicated by design to make you say, well, what he's saying sounds pretty good, so I'm going to buy what he's saying.
Right.
But then later on down the road, you eventually find out, oh, it's not quite what they said. Right? And the best way visually for you guys, and I'll end my part with this, is you have a screwdriver and you have a screw. Okay? The screwdriver is the best tool to undo that screw. But you don't have a screwdriver. And you go, hey, buddy, do you have a screwdriver? And they go, no, I have a pair of scissors, though. And you try to make that scissor edge loosen that screw up, right? And you might strip it. You might ruin the scissors. You might ruin the wood that the screw is in. But you're able to get that screw out. That's what these policies are. They are not the best, and there's usually consequences by using the scissors on the screw. That's the best visual I can think of.
They've stripped the screw.
They've
and
stripped
now you've
the
got
screw.
to look at some tools of how to still get that screw out.
Yeah. But you are usually able to.
Right.
Yeah.
Right. Well, hopefully that's a good summary for you guys on a couple concepts that we're seeing. They're viral concepts, to be honest, in the insurance world and in social media in general. This infinite money banking concept, it is not really as glamorous as it's sold to be. There's almost always better alternatives. So here's our advice to you, a couple things to help you choose better policies in the future and maybe try to understand if you're in a good policy now. Ask how much in fees and how much in commission is being paid to the agent. That should give you a good idea of how much margin there is on this policy and that it's something that they're incentivized to sell you. It might not be best.
You have to be confident when you ask that question. I myself struggle with that, but that is, you're right. You need to be able to ask, how much do you make on this?
And they have to tell you. They legally have to tell you.
Well, I bet you they avoid telling you.
Yeah.
They do have to. Like, if you ask that, they do have to tell you. But there's a lot of wordsmithing to get around that, right? Every financial planner that I've been in a meeting with, especially when I started at an insurance company, they never directly answered that question. They said, oh, glad you asked that. We get paid in 3 ways. And then they just tell you the ways they get paid instead of how much they get paid. Don't fall for that. Get a dollar amount or a direct percentage.
Right. Absolutely. Number two, ask them what do you think my premium would make if I invested in the market instead? They're not going to answer that question for you. One, because they're not authorized to make investment decisions. And two, because they don't want that comparison.
Oh, aren't you nervous?
They're going to go, well, the whole point of this is you're not going to lose all your money. Do you want to lose all your money? What if your money was, I'm sure your parents lost a lot in their 401k during the 2007 housing crisis.
Yeah.
That's the type of answer you're going to get. So look at someone, if they can't give you a confident comparative advantage, then they're not someone who can give you the range of options, which means you're fishing at the smallest pond. You're never going to catch a shark because you're not in a pond big enough to have a shark in it. Yeah. They're not going to be able to give you all the options. So know how much they're getting in commission. Understand, help them explain to you, or see if they're not unwilling to explain to you the comparison of this policy versus alternative non-insurance market options. Those two things are going to tell you a lot about the product and the insurance agent that you're working with.
Yeah. And there are financial advisors like Brandon, soon enough here, can sell insurance.
Right.
We will sell insurance, but it's going to be
it's not going to be index universal.
It's going to be on a need and a very bare bones basis, right? Like if you're a physician, we work with a lot of doctors. They're legally required to have disability. A lot of them want more disability than they're required to have. Right. Well, guess what? Now we have to understand disability insurance.
And malpractice insurance.
And
liability insurance on their office, and health insurance if they die. And, they might have 5 insurance policies. None of those are cash value investment policies. They're all insurance for a purpose.
He just mentioned 4 or 5 different policies. A lot of the times you have 4 or 5 different people who are involved in that.
Right.
That's how complicated these can be. So it's best to just either become an expert yourself or really get an advocate who is legally required. We beat that word to death, fiduciary. I don't even like the word. It's not a good word for what it means, but you got to have someone like that. Otherwise, you're going to get taken advantage of. Okay.
Right.
And that could mean, just like in this situation, millions of dollars. And I don't mean that lightly, right? Hundreds of thousands on the savings side, 100,000 on the investment side. That could be more than $1 million.
If you're thinking of making a insurance or an investment decision, talk to a professional, get good advice. Even if you don't work with them, I think their advice will help you a lot. Well, thanks for joining us on another episode here of 15 Minutes of Finance. We hope you learned a lot about some intricacies of insurance policies in the insurance world. Subscribe to the podcast, to the YouTube channel. We have audio only on Spotify, Apple Music. We have videos on Instagram, YouTube. Follow us wherever it's convenient for you to consume information. Share with a friend who you think could benefit from this type of knowledge. And as always, invest early.
Invest often.
We'll see you next time.